Something big just hit the markets today. The US dollar suddenly weakened, sending gold and silver soaring as traders rushed to price in a faster Fed rate cut. Stocks are climbing, but beneath the surface, tension is building, because this exact setup appeared right before the last major market reversal. And the most surprising part, almost no one is talking about the real reason behind today's move. Let's decode what's really happening, why the dollar's drop could change everything, and what it means for your portfolio before the next Fed decision. In the last 24 hours, the US dollar index slipped to around 99, hitting its weakest level in weeks. At the same time, gold jumped to roughly $4,227 per ounce, and silver climbed to about $58 per ounce, as investors rushed towards safe haven assets. US 10-year Treasury yields moved to around 4.08%, and S&P 500 futures edged up by roughly 0.17%. These moves are signaling growing bets on a rate cut by the Federal Reserve and the clear shift in market expectations, making it a critical moment for investors to watch closely. So here's what actually happened. Over the past 24 hours, the US dollar weakened significantly as traders reacted to a fresh wave of economic data showing slowing growth, softer than expected job numbers, and rising concerns about future economic momentum. The Federal Reserve hasn't officially changed its policy stance yet, but markets are now pricing in a faster than expected rate cut. This shift in expectations triggered a sharp surge in gold and silver as investors scrambled towards safe haven assets, signaling rising caution in the broader market. Meanwhile, stocks moved higher, driven largely by optimism about cheaper borrowing costs ahead, but this rally is more sentiment-driven than supported by strong fundamentals. On the surface, it might look like a routine market reaction, but when you dig deeper, today's moves tell a more intricate story, one of shifting investor psychology, hedge funds positioning aggressively in anticipation of policy changes, and subtle early warnings of potential market volatility. This combination of dollar weakness, rising precious metals, and cautious optimism in equities forms a pattern that has historically preceded major market turning points, making it a crucial moment for investors, traders, and anyone watching the financial markets closely. But here's where things get really interesting. Beneath the surface, today's moves reveal a hidden risk that most investors aren't even talking about. The real story isn't just a weaker dollar. It's about how traders, hedge funds, and institutional investors are quietly repositioning themselves ahead of the next Federal Reserve decision, preparing for potential market turbulence. Bond traders are aggressively pricing in deeper rate cuts, while hedge funds have been steadily increasing their long positions in gold and silver futures over the past week. At the same time, liquidity in the Treasury market is tightening, which is often a subtle but important warning sign that stress is building behind the scenes. When you combine these factors, a weakening dollar, surging precious metals, shifting bond yields, and tightening liquidity, a very specific pattern emerges, one that has historically appeared right before major market pivots and unexpected volatility spikes. This isn't typical market behavior. History shows that when these 3 or 4 elements align, sudden and sharp market movements often follow, catching unprepared investors off guard. Even more concerning is that these moves are happening quietly, without the fanfare or headlines that usually accompany major market events. Essentially, the market is sending early warning signals that a bigger move may be on the horizon, and only those watching closely, analyzing the underlying dynamics, and understanding the subtle cues will recognize the risks in time and potentially position themselves advantageously before others react. So what does all of this mean for the markets right now? Let's break it down in detail. Gold and silver are reacting sharply because a weaker dollar, combined with rising expectations for a faster Fed rate cut, creates a classic safe haven rally. Historically, whenever the dollar drops and rate cut baits rise at the same time, precious metals surge as investors rush to protect their portfolios. This isn't just a short-term move. It signals growing caution among major players about potential volatility ahead. Stocks are climbing for now, led by tech and large-cap names, but it is crucial to note that much of this rally is driven by sentiment rather than fundamental strength, meaning it could reverse quickly if confidence wavers. The unusual weakening of the dollar at a time of global uncertainty suggests that foreign investors are repositioning aggressively, and capital flows are shifting in ways that could amplify market swings across multiple asset classes. Bond yields are also moving, reflecting growing expectations of Fed rate cuts and changes in risk appetite among institutional investors. When you connect all the dots, surging metals, dollar weakness, cautious optimism in equities, and shifting bond yields, a larger narrative emerges. The market is quietly adjusting to expectations of a bigger move ahead. Traders and investors need to recognize that this combination of factors has historically preceded periods of heightened volatility and significant market pivots. In addition, liquidity in key markets, including treasuries and equities, is showing subtle signs of tightening, which could exacerbate price swings if major events or announcements trigger sudden reactions. For anyone paying close attention, these interconnected signals provide a roadmap of potential market behavior, showing not just what has happened, but what might happen next. Understanding these dynamics can give investors an edge, as today's moves are sending early warnings of shifts that could ripple across multiple markets, from currencies and bonds to stocks and commodities. Essentially, this isn't just about short-term gains. It is about preparing for a market environment that could become increasingly volatile and unpredictable in the days ahead. Now let's talk about what to watch next, because this is where things could get really interesting. There are several critical signals that could determine whether today's market moves are just a short-term reaction or the beginning of a larger trend. First, keep a close eye on the US dollar index. If it falls below key support levels, gold and silver could surge even further as investors rush to safe haven assets. Second, monitor US 10-year Treasury yields carefully. Any break above or below significant levels can indicate a major shift in bond market sentiment, affecting everything from equities to commodities. Third, upcoming Federal Reserve speeches and announcements will be crucial. Even subtle hints of a faster or slower rate cut can trigger sharp moves across multiple markets. Fourth, global risk sentiment matters. If foreign demand for the dollar continues to weaken or geopolitical tensions rise, it could put additional pressure on the greenback while boosting precious metals and other risk-sensitive assets. Finally, watch trading volumes and liquidity in key markets. Sudden spikes or drops can signal early warning signs of volatility ahead. All of these indicators together will help investors and traders anticipate the next big moves, and missing even one of them could mean being caught off guard in an increasingly unpredictable market environment. At the end of the day, today's market reaction isn't just about a weaker dollar or rising metals. It's about what the market fears may come next. When you connect all the dots, gold and silver climbing, treasury yields swinging, hedge funds and institutional investors repositioning, and the dollar weakening, a clearer picture emerges. The market is quietly preparing for something bigger behind the scenes. The next significant move won't come from the charts alone. It will likely be driven by decisions from the Federal Reserve, reactions from major banks, or shifts in global capital flows. Investors who recognize these subtle warning signs early can gain a real edge, while those who ignore them may be caught off guard. This is a critical moment, and understanding the underlying dynamics today can make all the difference in navigating what may come next in the markets. We'll keep tracking these market moves and bring you updates as they happen. Stay alert, watch the key indicators, and be ready to act. Understanding the story behind the numbers is what gives smart investors an edge. Stay prepared, and we'll navigate these shifts together.